Hello everyone, my name is Zulfiqar and welcome to the first video of Income Investors. With me today is John Whitefoot, but before I go into any details, a little bit of disclosure. Understand that the opinions in these videos are just that, opinions of our analysts. This video is for informational and educational purposes only, and nothing here should be considered as personalized investment advice. All investments, no matter how safe they sound, they have risks. Please read below about warnings on investing. Hey, John, how's it going?
Good. How are you doing, Mo?
Good. Let me talk a little bit about this investing principle that I hear all the time. Buy when there's blood in the street. And pandemic was one of those moments, in my opinion, where certain industries just got decimated, but they weren't that bad. If you looked and if you took some time, did some due diligence, you could find some great opportunities. And I believe you have a company that you want to talk about that was they did things differently during pandemic. So if you want to go ahead and take over.
Yeah, absolutely. This company ran into the streets when everyone was fleeing the village. The one industry that seemed to be more decimated than others during the pandemic was the restaurant industry. Globally, thousands of restaurants shuttered their doors. Millions of people were out of work. Yeah. It was horrible. It was a desert. And of course, it wasn't supposed to be that way. Yeah. I was just reading that in 2019, they predicted that in 2020, restaurant sales would reach a record $899 billion. Wow. That would have been the 11th consecutive year of growth, but obviously that didn't happen.
Yeah.
Sales at quick service restaurants fell by more than 13%. Full service restaurants cratered almost 40%.
Wow. That's crazy.
But eventually the economy reopened, and by 2022, sales were at $937 billion, which means they'd already topped pre-pandemic levels.
Wow.
And in 2023, the National Restaurant Association predicts that sales will increase $60 billion year over year to $997 billion.
So almost hitting
the restaurant industry is back. It's above pre-pandemic levels. And companies that position themselves during the pandemic are fully better prepared to capitalize on the resurgence than companies that went and hit their tails during the pandemic.
Right.
And the one company that did that, I think, better than almost any other is Fat Brands.
Oh, interesting. What do they do?
They are a global franchising company.
Okay.
So they acquire, market, develop quick service, fast food, casual restaurant concepts around the world.
Do they have any well-known brands that we may have heard of?
They currently own 17 brands. Round Table Pizza.
Okay.
Fat Burger.
Okay.
I've helped their bottom line.
Okay.
Marble Slab Creamery.
We've heard
Rockets.
Yeah.
Hurricane Grill and Wings, Pretzel Maker, Native Grill and Wings, Ponderosa, Dog on a Stick. There's a whole bunch. There's 2,300 units or franchises around the world.
Oh, that's interesting. And so what did they do differently during pandemic? We were talking about it earlier. What did Fat Brands do that other restaurants may not have done?
They weren't nearly this big before the pandemic.
I see.
But once the pandemic set in and everyone was running for the exits, they opened their checkbooks.
Oh, so they did the blood in the street.
Yes, absolutely. In September 2020, they completed the $25 million acquisition of Johnny Rockets, 325 locations in over 25 countries. And they did a bunch of acquisitions in quick succession. In July 2021, they bought Global Franchise Group for $442.5 million.
Wow.
They're the name behind Round Table Pizza, Great American Cookies, Hot Dog on a Stick, Marble Slab Creamery, and Pretzel Maker.
Yeah, so essentially, these guys were buying things pennies on the dollar when everybody was running away, essentially.
It sure seems like it. Yeah. I'm sure they couldn't buy these same brands in 2023 for what they paid for them in 2019, 2020.
Yeah, that's impressive. And how's their, how are their financials now? Are they improving? I would assume if restaurant industry is doing well, are they doing above industry, below industry, compared to their peers? How are they doing?
They seem to be reporting strong financial results. Again, they didn't do any, and a lot of that has to do because of their acquisitions. They didn't make any acquisitions in 2022, but they opened up a rash of new units, which resulted in a year of historic growth. It
Okay.
opened 142 new stores in 2022, including 44 in the fourth quarter alone.
Wow. So expanding fast.
Yeah. And it expects that to go even quicker in 2023, where they could open in between 150 and 175 units.
Wow.
So, of
So
course, as you're saying, this resulted in really strong revenue growth. In the fourth quarter of fiscal 22, revenue jumped 40% to
wow.
103.8 million. The company reported a net loss of 70.8 million.
Okay.
And adjusted EBITDA was up 88% at 19.6 million.
Those numbers are impressive. And in the restaurant industry, usually seems to be like usually is considered a boring industry. You do see some growth, but nothing. 40% growth in revenue is impressive for sure. How are they?
Full year revenue increased 242%
Oh
to
wow.
407 million.
Okay,
Again,
yeah.
and they reported positive EBITDA of 88.8 million, which is 300% above 21.1 million from 2021.
Oh, well, that's impressive. And now let's talk a little bit about how do they treat their shareholders? Dividends, our favorite thing.
They have to be one of the best, if not the best, restaurant stock when it comes to dividend and share price appreciation.
I see. And how are their dividends looking like? Have they been growing? What's McDonald's doing or Starbucks doing compared to fat brands?
They're wishing they were fat brands. In 2018, they paid 36 cents a share.
Okay.
And this year, they're up to 56 cents per share.
Okay.
So it's been growing at 9.2% annually. Although there was a bit of a hiccup during the pandemic,
Okay.
They ceased
They had
paying
to
dividend, which isn't a big surprise.
Yeah, but they went out and bought everything, so that's
yeah. They spent almost $1 billion on restaurants,
Right.
so they used that capital wisely to expand their operations while everyone else was, wondering what to do.
Right.
And so their 56-cent annual dividend works out to a yield of 7.58%.
Okay.
That's far in excess of the 6.0% inflation rate right now.
Yeah.
And far above the industry standard. For example, Wingstop, their dividend is 0.41%.
Okay.
Starbucks is 2.11.
I see.
McDonald's is 2.25, and Wendy's is getting up to that 4.66. Brands is.
How's their stock done over the past year or past 3 months year to date?
Yeah, over the last 3 months, they're up a whopping 32%.
Wow. Okay.
And 50% year over year.
Okay.
And no, 50% year to date and 1.1% year over year.
Okay.
But that's astounding when you consider what the S&P 500 has been doing.
Okay, and mostly in the red. Right, and like we like to talk about what Wall Street people are thinking as well, just because Wall Street analysts tend to have a lot of influence over large institutions, and they have a lot of call it clout, and they can bring in buyers to the to the stock. What are they thinking, and what's their estimates like, and or price target on the stock?
Yeah, just in spite of the inflation crushing yield and market crushing stock market gains, Wall Street still thinks it's seriously undervalued.
Okay.
The average 12-month share price target for fat brands is $25, which is points to potential upside of 240%.
Oh wow, that's impressive capital appreciation if that actually becomes the case.
Well, especially when you consider everyone from Jamie Dimon to other analysts and CEOs expecting the S&P 500 to drop 20% this year.
Right. Yeah.
That's a huge gap. And especially in an industry that everyone thinks is cyclical in nature and doesn't do well during recession or bad economic times. But we're seeing that with their wise, astute acquisitions, people are going out around the world to dine.
Yeah.
Especially at their restaurants.
Yeah. That makes sense. John, I thank you for this amazing company that you don't hear about much.
No,
you usually hear about the McDonald's and the Starbucks and the Wingstops of the world, but fat brands is something you don't hear about, and you've given us quite a bit today.
If you do a little due diligence, you look under the hood, you can find a lot of great stocks, that high dividend yielding stocks that everyone else is ignoring, only because they have a high dividend yield.
Yeah.
But if people look under the hood, they can see that there's great stocks like fat.
100%. John, thank you so much, and we'll chat soon.
Oh, I hope so. Take care.
Thank you. Everyone, thank you so much for watching, and we'll be back soon.